just a trade away from becoming an investor.
This is an ad for Robinhood, the flashy online brokerage that made free trading simple and ushered in a trading revolution.
Robinhood changed the game for everyone.
Before its IPO, it was one of the most valuable startups in Silicon Valley. In the first quarter of 2021, its revenue had more than quadrupled from a year before. And its IPO was highly anticipated by investors.
Robinhood struck gold when this perfect set of circumstances all came together to fuel its rise. And then we saw, a similar perfect set of circumstances kind of lead to its fall this year.
But the IPO didn't go as Robinhood might have hoped. The flurry of attention surrounding the company had attracted regulators, who began examining things such as the way Robinhood makes its money. And market forces were starting to shift. By the summer of 2022, the share price had slid by around 75%. So, what went wrong? Robinhood was launched almost a decade ago, but it didn't really take off until 2020. And when it grew big. By last summer, Robinhood had grown its funded customer accounts by 130% in a year, had opened offices around the country, and was preparing for the IPO. Here are co-founders Baiju Bhatt and Vlad Tenev.
It's another day.
It was really this perfect cocktail of a number of different factors all coming together at kind of the exact same time. What we had was during the pandemic, millions of new individual investors flocked to the markets. They had a lot more time on their hands. Some of them even had these stimulus checks and a little extra cash in their wallets, and they were looking to deploy that, sometimes in the stock market.
One of Robinhood's biggest draws? The system that allows it to offer free trades to customers while still making money itself. It's called payment for order flow. And here's how it works. Let's say you open the app and purchase 10 shares of a stock for $25 a share. Robinhood will send your order to a high-speed trading firm, which uses powerful computers to make lightning-fast trades. The high-speed trading firm will sell you the 10 shares of stock from its inventory. There's usually a small difference of a fraction of a penny between the price it gets in the marketplace and the price you get. That's how the firm makes a profit. For instance, it might have bought the stock for $24.99 and change. Then it turned around and sold it to you for $25 while pocketing the difference. High-speed traders do this over and over again, and the profits can add up to hundreds of millions of dollars. Meanwhile, Robinhood gets a cut too. High-speed trading firms send Robinhood rebates in exchange for the right to handle customer trades. Usually, this is also a small fraction of a penny per share. These rebates are payment for order flow, and they account for most of Robinhood's revenues. So at the end of the day, the high-speed trading firm and Robinhood both make money, and you have 10 new shares sitting in your Robinhood account. Robinhood relies more heavily on payment for order flow than other brokerages. In the first quarter of 2021, the company recorded that more than 4 of every $5 it generated were from transaction-based revenue, which encompasses payment for order flow. That same quarter, a few meme stocks like GameStop and AMC were sent to new highs as individual investors flooded the market.
And what we saw is individual investors started downloading the Robinhood app solely to trade those stocks. They would add the app to their phones, and they would look to buy a slice of GameStop or AMC. And Robinhood's app was just so easy to use.
By the fall, Robinhood's share price began to go downhill. The GameStop and AMC frenzy had caught the eye of regulators, who were concerned about the system where high-speed trading firms make payments to brokerages.
Some brokers will say that these payments allow them to charge 0 commissions. But there's no such thing as a free lunch.
Critics of payment for order flow said it presents a conflict of interest for brokerages and may prevent investors from getting the best possible deal on their trades. Robinhood has said that routing orders to high-speed traders benefits investors because it gives them better prices than they would get if their orders were sent to a stock exchange.
These practices have really led a lot of people to ask, are we getting the best deal on our stock orders? And are we getting the best prices on our stock orders?
Then another thing that had helped Robinhood's success turned on its head. The Fed raised rates due to inflation, and in response, the markets tumbled.
Robinhood was the ultimate bull market stock. And when the bull market essentially came to an end, that hurt Robinhood.
In April, as share prices continued to decline, the company shifted its focus from rapid growth to cutting costs. Robinhood's CFO said in the Q1 2022 shareholder call,
We needed to grow that fast, but it resulted in inefficiencies in the organization, duplicate roles, and sometimes just more headcount than is needed, particularly as we deliver on optimizing our workflows. So earlier this week, we announced a reduction in force affecting 9% of our team.
Then, in June,
SEC Chair Gary Gensler proposing rule changes that would affect how Robinhood, TD Ameritrade, Schwab, and some of the other big brokerage firms have to handle customer stock trades and therefore how they make money.
some Robinhood executives voiced concern. The SEC's proposed rules would have impacted 12% of that quarter's net revenue from routing stock orders. Investors were also concerned. Robinhood's stock dropped about 11% in the 4 days after the proposals were reported. The news of the SEC regulations, combined with a sharp slowdown in customer trading, drove the company to take action again. CEO Vlad Tenev announced in the Q2 shareholder call,
"We made a tough call to further reduce our staff, which we announced the details of yesterday.
The second round of layoffs amounted to about 23% of the company.
These are hard decisions, but we believe they better position our business for the long term."
As of August, Robinhood reported its monthly active users fell 34% from a year earlier. Revenue dropped 44%.
Robinhood has been hit harder than some of the other retail brokerages, mainly because of the reliance of its revenues on some of these more riskier, more speculative products like crypto and options trading.
Compared with larger competitors that are entrenched in the industry like Charles Schwab or Fidelity, Robinhood's users tend to be younger and have less money in their brokerage accounts. And Charles Schwab's share price hasn't dropped as much as Robinhood's. So, what's next for the company? Robinhood's chief brokerage officer told the Wall Street Journal in June that its explosive growth in 2020 and 2021 used a lot of resources that otherwise would have been invested in longer-term projects. And new product launches were in the works. However, the path forward for Robinhood may depend on how it handles business in a market that isn't as hospitable as it used to be.